Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Now the first half of 2021 is behind us. We can look forward to sunny weather, possible trips abroad, and the obvious Euro final on Sunday. But how have the first 6 months of the year been for global investors, and what considerations should they have for the rest of the year and beyond? To answer these most pressing questions, I'm delighted to once more have Stephen Anness on the channel, head of the Henley-based Global Equities team at Invesco and lead manager for the Invesco Global Equity Income Fund. But first, before we get into the content, if you are enjoying the channel, it'd be wonderful if you could subscribe. That helps us all in delivering our content to you on a regular weekly basis. So, onto the content. Many thanks once again, Stephen, for coming onto the channel and furnishing us with your wisdom. So cracking straight on. Now that the first half of 2021 is behind us, how have global equity markets performed year to date?
Well, Andrew, thanks for having me again. Good to be here. I won't make any predictions about Sunday, perhaps, but well, look, in terms of global equity markets, it's been a pretty strong start to the year. Most of the markets we're invested in are up between sort of mid-single digit and 15% in some cases. Particularly US markets have generally done better. But Asia has lagged. Japan and Hong Kong are sort of marginally up to sort of flat this year. But I think that's a pretty remarkable result, really, in the context of the sort of recovery from the bottom last year. If you think about where we were in March, April last year, strong performance last year, and that's kind of carried on into 2021. Albeit within that, there's been a lot of sort of oscillation between different types of sort of, I guess, factors working within the market.
Mm-hmm. Looking into the future, I don't expect you to have a crystal ball, but there are obviously discussions that everyone's having at this moment in time. What do you view as the main headwinds and tailwinds currently to global equity markets?
Well, look, I'll perhaps start with the tailwinds. But look, I think that the first point I would make is both the tailwinds and the headwinds are quite significant, and I think in many cases quite hard to judge the outcome of, but I'll perhaps sort of try my best to frame how we're thinking about it. And look, I think from a tailwind perspective, I would say the economic recovery is still, we think, pretty well embedded. And I know there have been some kind of questions about that, particularly in the US recently with the sort of slowdown in hiring, but I think it's not just a demand for labor issue there. I think there's also a sort of supply issue going on. And, when people are being basically paid to stay at home, I think, unfortunately, that is part of what's going on. Mm-hmm. So I still think the economic backdrop is quite robust. And the reason I think that is because consumer balance sheets are very strong. In this period of time, it's quite different to most previous sort of downturns that we've had. Consumers are actually better off. Now, look, obviously there are individuals where that's not the case, but in aggregate, consumer bank balances are up quite significantly. People have been paying down debt, and in fact, one of the issues some of the commercial banks have had this year is that people haven't wanted to borrow, they haven't needed to. So, I think those sort of very fundamental pieces are still pretty strong. I think corporates are in a good place, and generally capex and hiring intentions are positive. Credit spreads are still narrow, and clearly central banks are generally remaining supportive of that recovery and saying they're not going to sort of tap the brakes too early. And the other point I would make from a sort of market and stock market perspective is that earnings revisions generally are still pretty positive. I think a lot of people are finding it hard to sort of model the impact, obviously, of the annualization of a pandemic, and many sectors and companies are doing much better, sort of 12 to 15 months on from the bottom of economic performance than they normally would do. And I think that operating leverage that's coming through is providing a powerful tailwind to sort of earnings revisions. Now, the headwinds are that I think quite a lot of that's priced in to the stock market. Clearly, there's been a big recovery in cyclicals, particularly some of the industrials, commodities. That sort of happened this year, albeit there's been a very recent rotation. Perhaps we'll sort of touch on that. So look, I think over the next year or two, as those earnings revisions, earnings growth are delivered, I would expect the market to derate. But I think that's fine. That's sort of what normally happens.
Mm-hmm.
Look, clearly we've got various variants of the virus going on and creating some sort of restrictions in certain places, particularly in Asia. There have been some sort of further restrictions in place. I think the US is interesting that they've been open a while now and seem to be maintaining that. So, but I think we need to be aware that could be a headwind. And then look, finally, I think the unknown, and this could be a tailwind or a headwind, is that we've thrown a lot of stimulus at this problem. And how that manifests, I think, is difficult to know at this point. And it could end up in a much stronger, much hotter economy, and the Fed having to sort of reverse thrusters in the US at some point and sort of apply the brakes, which would clearly have ramifications for a lot of markets globally. So sorry, that was a very long answer to your question, but I think there's just an awful lot going on. And I think you're right to think about them in headwinds and tailwinds, and which of those forces is necessarily stronger over certain periods of time, I think, is a good question.
Absolutely. I think there's so many different factors to consider. It's a fascinating time. Thinking about all of that, then, therefore, how are you currently positioned in the Global Equity Income Fund, and what sort of considerations are you making for that?
Well, look, I think perhaps to sort of frame that, and I can't remember exactly when it was we last spoke, but if I sort of take the last sort of 9 months, I mean, there's been huge variance in the market. So if I sort of take that end of October, early November period where we got the vaccine news, markets rallied very hard on that. And there was a big internal rotation in the market as well. That, things that were travel and leisure exposed did brilliantly. The sort of growthy stocks that had performed well, did less well. And then coming into this year, that we had that sort of big cyclical rotation, and that was something that was a good tailwind for the fund. But we sort of took some of that bet off effectively in April time. We felt a lot was getting priced into the market, and by that point we were able to buy some very, very high quality companies with very robust balance sheets, good dividends, just very resilient companies at valuations that they had not sort of traded on, particularly relative valuations that they'd not traded on in some time. And within that, I guess I'm talking about some of the consumer staples companies, some of the sort of tech growth companies, some of the semiconductor companies. And so I suppose through that lens, you'd say that effectively the portfolio became a little bit more balanced. And then in the recent weeks, we've seen a very sharp rotation, not necessarily at the headline level, but under the surface, where companies that are in the sort of lower quintile of valuation have underperformed dramatically versus their growth counterparts. And this, a lot of it's being sort of put down to the Fed minutes and this big shift that we've seen in the US 10-year moving from sort of 170 to 130. So that rotation's kind of gone on, which is now throwing up opportunities in perhaps some of those more cyclical areas again. We are, as ever, bottom up stock pickers. We're focused on these sort of idiosyncratic opportunities that we see. But I think what's interesting is that around us, that opportunity set is changing often quite quickly because people are sort of being swayed by macro forces, by the 10-year, etc. And as you know, we're not wedded to one particular style. And I think at this point in time, that's been really helpful to the portfolio to be able to take advantage of those opportunities. So look, we have positions in quite defensive companies. We have positions in what you would describe as growth companies, and we have some financials and more cyclical positions as well. And that balance is just sort of evolving as we go through the year, as this opportunity set sort of changes.
I think from my perception, what you've highlighted with regards to the potential headwinds and tailwinds, that there is a potentially huge disparate nature of potential outcomes in the markets. So yes, first of all, being kind of style agnostic, focus upon the bottom up stock picking is absolutely crucial, but also, and something that I think has been missed for quite a while now in terms of fund selection, the importance of active management. When these potential outcomes become so broad, then that's when active management really comes to the fore, because you've got the opportunity to move around. You've got the opportunity for decisions to be made for that can change, and we've seen it recently, the whipsawing nature of equity markets, and that doesn't even start to consider the income benefits within an inflationary backdrop, with the dividends being paid, one of the natural hedges towards inflation, top down focus. So personally, it's a really, really fascinating time to be investing, and certainly with your experience and your style, it's really important that people take into consideration what you're doing and how you're doing it. But once again, Stephen, it's an absolute pleasure to talk to you. We'll catch up in 6 months, and we'll see how things are. We may be in a completely different world, who knows? But you take it safe. Fingers crossed for Sunday, and I'm sure we'll catch up soon.
Andrew, great to see you again. And as you say, fingers crossed for Sunday, and we'll chat soon.